Well, hi there, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about the single most important factor that determines the long-term performance on your portfolio. So you get some great value and tips out of this particular video on successful stock market and portfolio investing. Now, if you're new to the channel, make sure you hit the subscribe button. We're posting content all the time, quite literally on different aspects of retirement. So if you don't want to miss the future content on this series or other topics, hit the subscribe button and the notification bell so you're alerted to new content that we're uploading. Okay, we're going to talk about the most important principle around portfolio construction. But before I do that, I want to ask you three questions. And so the questions are, what factors do you think drive most of the performance in your portfolio? Is it number one, consistently timing the market, knowing when to be in the market and out of the market? Is it number two, the individual securities or investments you choose for your portfolio? Or number three, your mix of investments in your account? So which of those three factors do you think drives most of the performance? Okay, well, the most important factor, in fact, it drives 95% of the performance numbers are driven by really your mix of cash, stocks, different kinds of bonds in the portfolio, potentially real estate. It's your mix allocation that determines the majority of performance, over 95%. Okay, how are we going to leverage off this idea that 95% of your performance is driven by your allocation of assets, your mix of assets? Now, I'm going to link to the description under this video some research that confirms what I'm claiming right now. But there are four principles you need to keep in mind to fully maximize this idea that your asset mix drives most of your performance. Let's look at those four ideas. Idea number one. Now, when it comes to investment performance and our goals and return objectives, there's just so much information out there that it can become very, very overwhelming, whether it's the internet or devices, whether it's newspapers, periodicals, or neighbors, you name it, all this information is coming at us. Everyone has a perspective. You need to sit back for a moment and first of all assess what are your goals, what returns do you need to get to achieve those goals. That is an analysis of one. That's you and your family. Now, I'm going to include a link to this video that will take you to a discussion on the analysis that we do for our own clients. So there's a bit of homework and there's analysis and forecasting. And we bring together all the different aspects of your planning to try to determine what that return objective needs to be. And it needs to be looked at on a regular basis. So when you look at all this information out there, it's really just your return that's going to be important, and you need to benchmark your progress against this particular return number. That's the only thing that's really important. Okay, let's look at the second principle. Now, the second principle not only defines the kind of performance or returns you're going to get on your portfolio, but it also helps to define the range of one-year returns you could experience as well. So let's take a look at that. Now, this is a great chart that was put out by Vanguard Investments in collaboration with Morningstar. And what this chart illustrates is the average compounded returns of various portfolio mixes, very broad asset mix categories. And then what it does, it looks at the swing rate in the portfolio in any given year. So we have the average return over time, and then we have the one-year swing rate on the account. Okay, so that's now we're talking about standard deviation or risk or volatility in the portfolio. So let's take a look at a portfolio that is 80% bonds, 20% stocks. This chart goes from 1901 to 2016. And so you can see that over this time period, the average compounded return was 5.8%. But the swing rate in a given year was anywhere from minus 4.5% to positive 16.4%. Now, some of you looking at that will go, well, how would you have a loss on a portfolio that's 80% bonds? We have other videos that talk about how bonds get priced, but if your bond is a tradable bond, bonds can fluctuate based on prevailing interest rates. So I'll give you a quick example. If you've got a bond paying 2% and interest rates go up to 4%, there's not a lot of people that you want your bonds. Now, if you hold the bond to maturity, you're going to get your interest rate and you're not going to sell the bond at a loss. You'll get your full par value back when it matures. However, when you're looking at your bond and rates are now 4 and you're getting 2 in your bond, no one wants your bond. So your bond has to be traded at a discount in the event that you want to sell that bond, okay? So that's how bonds fluctuate. We have other videos that go through that in more detail. Now, let's look at a portfolio that's pretty common out there. 40% bonds, 60% stocks. The average compounded return from 1901 to 2016 was 7.6% per year. But the range of return in any given year was 23.7% in the positive, that's a great year, and minus 9.7% to the negative. So this principle really is just to say we can have these average compounded returns, but your mix not only determines that long-term performance, but it also drives a certain level of variability year by year. The more return that you want, the more the variability. I know that it probably seems to be fairly straightforward, but a lot of investors forget about that. You cannot get the bull market returns without going through some of the variability. We've talked about the timing issue in the past. So we need to be prepared when we go into these portfolios that there could be some short-term variability in performance. Usually over 2 economic cycles, which is 10 years, you're going to come very close to the expected return. There's a range. If I look at the last 10 years on a portfolio of 40-60, 40 bonds, 60% stocks, you're typically going to see a range of return of anywhere from 4.5 to 6.5% return compounded. And the reason for the range of return is it depends on, over that decade, when you put money into the portfolio, when you took money out. If you happen to put money in, let's say at a bad time, and the market goes down, that's your initial, entry point, then obviously that has a bit of a negative drag on performance. You can have other investors that go in and just time it perfectly by luck, and they ride up this momentum, and that helps, give them that very nice glow of portfolio performance because they timed it properly. Okay, now let's look at the third principle. The third principle is kind of an overarching principle, and what I would say about it is, first of all, we've talked about this already in various videos, expect volatility. As well, there's certain behaviors you need to exhibit when volatility takes place. And you also need to understand that as we look at the sweep of time over the last few decades, this asset mix discussion is really a subject that leverages off some very powerful economic forces when it comes to investing. In other words, tinkering around the edges around timing the market and the individual securities, although that's not unimportant, the most important thing is to be in the market in quality assets. And the more you have in growth, the more risk you take on, but also the more potential return. The more you have in bonds or capital preservation assets, the less the return and the less the volatility. And we've talked in the past, you can't time market risk. So you have to make a decision based on your planning, what return do you need to achieve? Okay, so this third principle is understand that volatility comes with investing and what kind of behaviors should we exhibit when volatility takes place. So let's take a look at that. Now, this particular chart looks at time and dollar weight bias, and what I'm referring to here is this line going from, let's say, the first year to year 10 in a portfolio. We know that if we look at this little chart here, over time the portfolio is going up in value. And again, if I look at a portfolio that has 80% stocks or 60% stocks, what we know historically is this. As you look over this 10-year period, you can see that over almost any 10-year period you can take a look at, you're going to have at least 2 to 3 losing years. And you're going to have anywhere from 7 to 8 positive years. And the positive years could be quite variable. And when the positive years happen, often it's at the point of maximum pessimism. As you step back, it's very difficult to figure out when those positive years are going to be and when the negative years are going to be. Yes, when you look in hindsight, you can go through the economic tea leaves and kind of figure out the reasons why. But when you're in the middle of it, it's next to impossible to determine. So we know that over that 10-year period, 75%, let's say on average, will be positive years, 25% will be negative years. Now, your experience of your mix is going to be a subject of time and dollar weight bias. And what I mean by that is, if I add a whole bunch of money to the portfolio here, then that's going to bias my portfolio returns for a long time, because I had a lot of money going in, and just as I put money in, the market just shoots up. So I'm very happy. The same investor with the same investment mix could allocate here, and now they're unhappy, and that negative performance in that initial year is going to be a drag on performance over time. And it will likely take 2 economic cycles for that portfolio to approximate the expected returns that they're trying to achieve. So there is the timing of investment decisions, and the dollar amount of decisions going either in the portfolio or coming out of the portfolio that has a very profound impact on people's experiences of portfolios. So you can have an asset manager, a portfolio manager, a financial advisor design a portfolio, and they've used very sound principles in portfolio design, let's say, and they have 2 clients going in, and the only difference is timing and dollar weight bias. And the portfolio has been constructed using exactly the same principles, and these are sound principles. We're assuming the advisor really knows what they're doing. And the 2 clients have very different experiences. So you can imagine what the client's feeling like that had the negative performance right away. They may believe intellectually that their advisor is doing the right thing, but it's just a hard slog, right? But it's important that they do that. Now, as hard as it is to do, when you go through these negative years, it's really important, if at all possible, to add money to your portfolio or rebalance from your conservative assets into your growth assets. Number 2, if you're in retirement, you need to make sure that you've got other strategies in place to access income that are safe harbors. So you don't want to be selling out of your portfolio in these years because you're going to accelerate the drawdown and kill the goose that lays the golden egg too quickly. Okay? So we have volatility, we have averages, we have time and dollar weight bias that can really influence us psychologically and emotionally about how we feel about our portfolios. And the way that you respond to these biases is you go in the opposite direction. When the market's down, you make sure that you are adding back to the portfolio, to quality assets. If the market is up, you want to make sure your portfolio is being rebalanced and protecting those profits or adding back to other areas that are underperforming. Okay, now let's look at the 4th principle in these 4 principles we're talking about in terms of leveraging off the power of asset mix. Now what I'm going to do is I'm going to pull all these concepts together in this 4th principle. We're going to take a look at 3 really great slides, and the slides illustrate the following. Number 1, the kind of performance we could expect on portfolios that range from 100% income to mostly equity, and then what the range of returns are going to be. And so as we look at the average performance and the range of returns, we're going to look at range of returns over 1 year, 3 year, 5 year, 7 year, and 10-year performance numbers. So it really pulls all the information together. So again, remember where we came from. Portfolio design is predicated on doing effective planning and understanding what kind of returns you require. That comes from analysis and forecasting. Once you know that, then you begin putting together a portfolio mix that has a high probability of driving those numbers for the lowest level of risk. That's the bias that I come to the table with because most of our clients do not want to take on unnecessary risk. It doesn't mean that you shouldn't have a satellite account where you're trying to hit home runs, but this is about your serious money, your pension money for retirement. And so we're going to take a look at these 3 mixes, and it really underscores the importance of time and range of return. Let's take a look at that right now. Now this first portfolio is a 100% income portfolio, and we're using, for illustration purposes, an investment counsel service called Evolution, which is a mix of various investment pools to come up with these asset mix designs. Now this particular portfolio, what you can see here, if we go in this chart, you can see over 1 year, 3 year, 5 year, 7 year, and 10-year performance numbers. Now keep in mind this portfolio is a bond portfolio, right? So if you look at the average returns over 1 year, 4%, over any given 3-year return, 3.6%, if it were to 7-year, 3.6% compounded, and 10-year, 3.7%. And that's actually pretty good performance. When you think that risk-free investments were probably paying 1.5 to 2, this 100% bond portfolio is paying a premium after fees above what risk-free assets were generating. However, there is a range of returns. So we talked about before the bonds can fluctuate in value. And so if you look at any 1 year, even though the average was 4, the range could be anywhere from 11.3 to minus 4.3%. If we look at 3 years, you can see now the portfolio could be a range of break even to 7.2% compounded to an average of 3.6. Now getting back to that idea we talked about in the previous section, whereas dollar weight and time bias can have a real big influence on these numbers. Now, once we get to year 7, you can see that the average return is 3.6, and the range is 5.5% per year, 1.7% per year. And then by the time we get to 10-year performance numbers, the lowest 10-year range was 3, the highest is 4.2. Now we've compressed that range of returns quite significantly. So irrespective of when someone went in or out of the portfolio, there wasn't a huge difference over 2 economic cycles between the two issues, high, low, and average. Now let's look at the next portfolio. Now this portfolio is a portfolio that's made up of 40% income or bonds, 60% equities, and immediately what you see here is a greater range of performance. You can see that over 1, 3, 5, 7, 10 years, the average returns over time were 7.4, 7.2, 7.6, 7.1%. However, over a 1-year period, you can see the range could be anywhere from 36.2% to the positive, minus 13.1% to the negative. As we go out 3 years, the numbers in the range are compressed. So the worst 3-year performance was minus 2.8% per year, and the best 3-year performance was 15% per year compounded. So you'd be very happy with that, with an average of 7.2. If we go out to 7 years, 7.6% is the average. The best 7-year performance was 11.3, and the worst 7-year performance was 3.6% compounded. And then if we look at the 10-year numbers, 7.1% compounded, on the low end 4.7%, on the high end 9.5% per year. So you're seeing this compression. And again, it illustrates the importance of time, and time as a way of compressing the variability or fluctuations in portfolios. It's one of the reasons why you have to do your homework when you do your portfolio design. You have to look at your income requirements, liquidity requirements, how long you can afford to be in the market. Those are all important factors when you build portfolios. And now what we have is a 100% equity portfolio, right? So the range of performance over a 1 year was anywhere from minus 18.9 to 46%. And again, these numbers were over a decade of ending 2020, December 31st. And what you see is the average return was about 9 to 9.5% on the portfolio. Okay, so quite a bit higher returns over time than what a client could get on risk-free investments over that same time period. But there's quite a range over this 1 year. Over 3 years, the range of returns were anywhere from minus 4.7% compounded, not great performance, to a positive 20.2% compounded with an average of 8.9. If I go out to the 7-year numbers, we're now at 4.2% compounded at the low end, 13.5% on the high end, and an average of 9.5%. And then when we finally get to year 10, the average performance 8.5, the best 10-year average was 11.6, and the worst was 5.3. So you need to have these images in your back pocket when you're building a portfolio. So get back to my previous chart. When markets are down, you want to remind yourself that time is a way of averaging down that volatility. You want to use great years to harvest profits or rebalance the portfolio, poor years to add back to your portfolio. If you keep these things in mind, there's a higher probability you're going to make the good decisions around portfolio management. Well, that concludes the video. The most important thing you need to focus on in terms of performance generation is your asset mix. So hopefully you found the discussion helpful. Now again, if you're new to the channel, make sure you hit the subscribe button and the bell to alert you of new content that we put together on a regular basis. As well, we have some great links to the notes section of this video that you can get to at our website and other YouTube videos. And there's a page that will take you to our retirement coaching page. So if you're 5 years away from retirement and you're beginning to think about putting a solid plan in place, make sure you click that link. It'll give you some information, and you can reach out to us through our website at humphreyswealthgroup.com. Anyway, wishing you all the best in your investment, retirement, and wealth planning journey. You take care. Bye-bye.